Good morning, everyone. Thank you for joining us bright and early this Wednesday morning for today's Miller Johnson webinar. My name is Neil Williams. I am a tax partner in Miller Johnson's business section, and our topic today will be an update, giving a little bit of a refresher on employment tax relief provisions under the CARES Act and the Families First Coronavirus Response Act, or we'll shorthand that as FFCRA during the presentation today. Before we dive into taxes, as we've done with almost all of our webinars, I wanted to share a more general update on something COVID-19 related this morning. And I think luckily today we have some fairly good news. Yesterday, the Senate passed a new $484 billion relief package that includes $310 billion earmarked for replenishing the funding available for Paycheck Protection Program loans, which I think is good news for anyone on the call or any businesses out there that might not have been able to get applications in and have their PPP loaned before the initial pool of funds ran out. The House is expected to vote on and pass the bill tomorrow, which I think means that we could have a new stimulus bill in place and enacted by the end of this week. And that's maybe a little bit of a timely update or coincidental update as well, because today, last week when my colleagues and I were talking about potential topics for webinars this week, we thought it would be beneficial to loop back on some of these employment tax provisions because, while they're definitely important provisions under the CARES Act and a way that, depending on qualifications, a way that employers might be able to get some additional short-term liquidity, PPP loan applications in that process definitely seem to be taking the majority of the attention from our clients who qualified for a PPP loan over the last 3 or 4 weeks. We're starting to see some clients complete their process and get loans funded. And at that time, we've seen an uptick in questions around these tax provisions, I think, as attention kind of focuses back away from PPP loans a little bit into other provisions of the Act. So with that background, in slide 4, I laid out the 3 pieces of FFCRA and the CARES Act that are going to form the meat of today's presentation. Those are the employment tax deferral provided by the CARES Act, paid leave credits provided by the FFCRA, and employer retention credits provided by the CARES Act. It'll take us just about 30 minutes, I expect, to get through all 3 topics. If anyone's curious, we won't take the full hour that was allotted today, but I still think we'll get through a meaningful amount of discussion on the 3 topics and provide some important updates and details. On slide 5, I thought it would be helpful to tee up the conversation today a little bit by laying out what my goals are. And I wanted to do this because I think the approach to today's webinar is a little bit different than the prior tax webinars that Miller Johnson has done. We did the majority of those shortly after FFCRA and CARES Act were enacted, which means at the time we were really, we only had the language of the rules and maybe a little bit of legislative history to work with. And when you only have the black and white of the rules, and especially when they're rules that were pushed through fairly quickly, given the circumstances, that tends to, leave some unanswered questions, which was definitely the case with FFCRA and the CARES Act and these tax provisions. And also in both acts, a little bit of that was by design because the acts were written open-ended with instructions to the IRS to fill in the blanks by providing additional guidance and drafting and providing taxpayers the forms that they'll need to claim benefits under these tax provisions. So we've seen that done really in droves. It's really been an impressive effort by the IRS over the last, 5 weeks now since CARES was enacted, and maybe another couple weeks beyond that since FFCRA was enacted. The service has been very busy answering, providing guidance, focusing on the questions that they're frequently receiving or that they're seeing highlighted in, tax news media. So today, what I thought would be helpful with that background is taking the time to refresh on the basic rules and benefits under these 3 provisions, but also discuss some of those common qualification questions that I mentioned and the related guidance that we've seen from the IRS. And then also discuss next steps and action items for employers that believe they qualify and want to lay out an action plan to make sure that they get the benefit of the credits, which that's another area, like I was saying, in the last few weeks as people have wrapped up their PPP loan application process and started to try and make more formal plans on other provisions under the acts, that we've seen a lot of questions is, so we've confirmed we qualify. What do we need to do now to make sure that we're crossing our T's and dotting our I's on these tax provisions? So moving on to slide 6, and this is where we'll get into the substantive discussion today. Our first topic is CARES Act employment tax deferral. As a refresher, on slide 5, I've laid out the general rule. The CARES Act permits employers to defer the deposit and payment of the employer's portion of Social Security taxes, so the 6.2%, that otherwise would be due between March 27, 2020 and December 31st, 2021. For employers that qualify, the first 50% of all of an employer's deferred amounts will be due December 31st, 2021. So if we're looking at amounts that we could be deferring today, that's 21 months out. And the remaining 50% of all of an employer's deferred amounts will be due December 31st, 2022. So again, looking at dollars that we could be deferring today, that deferral continues for as long as 33 months. Okay, slide 7. Who qualifies? So the general rule is that all employers qualify, and that's regardless of size, employee headcount, whether an employer is a for-profit or a nonprofit, et cetera, with the one key exception. And what I'm about to read is more or less the language directly from the rule. And that's that employers that apply for a PPP loan and have all or a part of their PPP loan forgiven do not qualify. But as you can see at the end of this bullet, bold and underlined, see note on the next slide. And this gets into one of the areas that I really wanted to highlight today and was one of the big drivers for us wanting to do this update, is that in about the last week, the IRS issued additional guidance on interpreting that line from the Act. And what they issued is, I think, very taxpayer favorable guidance in terms of who can qualify for these deferral provisions if they're also planning to receive, and as most taxpayers who receive a PPP loan are also planning to get a piece of that loan forgiven. So slide 8 lays out that additional guidance, and what the IRS said is that, yes, even if you've received a PPP loan and you expect to have a PPP loan, at least a portion of your PPP loan forgiven, despite that language in the Act saying that you might not qualify, there are deferral options available for PPP loan recipients. And what the IRS said is that PPP loan recipients may defer deposits and payments through the date their lender issues the decision to forgive all or a portion of the employer's PPP loan. After that decision to forgive is issued, the employer is no longer eligible to defer future deposits and payments. However, deposits and payments deferred through the date of the forgiveness decision will continue to be deferred, with 50% deferred through December 31st, 2021, and the remaining 50% deferred through December 31st, 2022. So that's the same timeline as any other deferral under the general rule that would be available. It's the same timeline that's available to PPP recipients. And that is a little bit of a mouthful, I think. So I thought it would be helpful to work through an example with a little bit more detailed timeline on what those rules mean in terms of being able to defer now and being able to continue to defer through the date that a lender's decision to forgive all or a portion of a PPP loan is received. So the first 4 bullets on this slide work through the facts of our hypothetical example. So we're assuming that our employer's PPP loan is funded on April 20th, 2020. If that's the case, the 8-week forgivable spending period applicable to that PPP loan would end on June 15th, 2020. We're also assuming that our employer applies to its lender for forgiveness of its PPP loan on June 15, 2020. So immediately at the end of its forgivable spending period, it submits its application to its lender to receive a decision on forgiveness. And then finally, we're assuming that the lender issues its forgiveness decision on August 14, 2020. And that date is notable because that would be exactly 60 days following the date that our hypothetical employer applied for their forgiveness decision. And that's the maximum window that lenders have to respond to a request for a forgiveness decision and provide their decision in 60 days. So in this example, our employer could defer payment and deposit of the employer's share of Social Security taxes during the period beginning on March 27, 2020 and ending on August 14, 2020. So that's even for a PPP loan recipient, that's 4.5 months of the employer's 6.2% share of Social Security tax that we can defer. Our maximum there would have only been about 9 months if we count April through December for a taxpayer not receiving a PPP loan. So, in this example shows that we could still defer half as much and retain half as much cash as any other taxpayer, even though we received a PPP loan, and we can still defer, continue to defer the amounts that we have not deposited for 50% through December 31st, 2021, and 50% through December 31st, 2022. Slide 10 addresses the question we've received on what are next steps that we should be taking or should be preparing for if we are an employer that qualifies and wants to take advantage of this deferral provision. There are no immediate steps necessary to claim the benefit of this deferral. Specifically, what we're trying to highlight here is there's no special election or other IRS form that needs to be filed today in order to take advantage of the deferral. Employers can immediately stop depositing and paying their employer share of Social Security taxes, and the IRS has promised that it will issue a revised quarterly employment tax return form, so it's Form 941, and it will provide additional guidance in the second quarter of this year on reporting deferred deposits and payments. So there's nothing to be done right now. We know that additional forms and guidance are coming, but it's not here yet. But the key is that, I guess there's nothing to be done before you can start deferring payments, but you can start deferring payments now to take advantage of this deferral. Okay, moving on to slide 11. We're bridging into our next topic, which is paid leave credits available under FFCRA. Again, teeing up the discussion with a summary of the general rule. The first bullet here is not just the tax piece, but just a very, very high-level summary as high-level background. FFCRA requires certain employers to provide emergency paid sick leave and FMLA to employees who are missing work for COVID-19 related reasons. In connection with requiring employers to provide that paid leave, luckily FFCRA also provides a fully refundable tax credit equal to 100% of any amounts an employer is required to pay as emergency sick leave or emergency FMLA under FFCRA, plus an allocable share of qualified group health plan expenses, plus the employer's 1.45% share of Medicare tax. And I wanted to pause for just 1 second and hit on that first plus, which was in the calculation I just went through, which is plus an allocable share of qualified group health plan expenses. For employers who need to take advantage of that. So if, or actually, I'm sorry, excuse me, under FFCRA, everyone would want to. So if you have questions on how you can increase your FFCRA credits by allocable qualified group health plan expenses, it's beyond the scope of the discussion that I'm going to have today. But my colleague at Miller Johnson, Trip Vanderwall, he has done a really nice summary of what that allocation looks like, and also provides a little bit more details on which group health plan expenses qualify and which don't. You can find that on Miller Johnson's webpage. And obviously, reach out to your Miller Johnson attorney or reach out to Trip if you have any additional specific questions on that. Having touched on that, the last bullet on this slide, this is just one more note for anyone that's trying to project out what the total benefit of providing paid leave and receiving these credits could be. And the last bullet just highlights that eligible employers are also not subject to the employer portion of Social Security tax. So again, it's at 6.2% on wages the employer is required to pay as sick leave or FMLA under FFCRA. Okay. On slide 12, we get into the discussion of which employers qualify to receive credits under FFCRA. The general rule is that all employers required to provide emergency paid sick leave or FMLA under FFCRA qualify. Without getting into a detailed discussion on who's required to provide FFCRA leave, that generally means that private employers with fewer than 500 employees would be subject to FFCRA providing paid leave and also qualify to receive the credit. The key exception is that federal, state, and local government employers do not qualify for the credit, even though they are still subject, or they may still be subject to FFCRA. An additional note that I wanted to highlight in this slide, and this is another area where there was some ambiguity and there were a lot of questions when FFCRA was first passed. Employers that have completely shut down are not required to provide paid leave under FFCRA. And I wanted to note that in this tax discussion, just to be clear that in that case, then, therefore, those employers would also not qualify for any corresponding paid leave credits. So if you're completely shut down, you're not really in this FFCRA discussion, and you're not going to be eligible for any credits unless and until business picks back up and employees are back on payroll, and at that point might need to take leave for the reasons that qualify under the Act. Okay, moving on to slide 13. This slide lays out next steps and action items that can be taken by employers that are planning to take advantage of these credits. This is another area that I think is one of the key highlights for today's discussion. This is somewhere where the IRS has provided significant additional guidance following the initial enactment of FFCRA. And that additional guidance is taxpayer favorable, and really the key is that it's very facilitative, or it's the intent is clearly, and what the IRS is trying to do is clearly to get employers the cash to pay any required paid time off as soon as possible, including prior to getting employers cash prior to the date that paid time off wages are actually paid. So the first option for an employer that qualifies for the credits is to simply reduce payroll deposits today, including deposits of withheld employment taxes, whether that's the employer's share or the employee's share, and also ceasing deposits of employee income tax withholdings. And those deposits can be, payroll deposits can stop even in anticipation of an employer receiving credit. So if right now we don't have, we're not paying any FFCRA paid leave yet, but we have requests coming in. We know that we're going to be paying paid leave in the future. An employer can project out what they expect their total expense to be reasonably and in good faith, and can stop making their payroll deposits immediately in anticipation of earning the credits as that paid time off is taken. The second option on this slide is employers can file a claim for an advance of, and again, this is anticipated. So employers can file a claim for an advance of anticipated credits prior to the end of a quarter. And that's done by filing IRS Form 7200. And that provision becomes, again, for employers that are looking to get the cash as fast as they can, that Form 7200 becomes a backstop for employers who won't be able to self-administer the full amount of their credit under the first option. So if you're an employer and looking out, you say, here's the number of people that we expect to be paying FFCRA paid leave over the next quarter. If we stop making all of our deposits, here's the amount of cash that we expect to be able to set aside through not depositing. And I guess to give that example some numbers to really give it some teeth, say we have an employer that looks out over the quarter and projects that they're going to be paying $50,000 of required paid leave under FFCRA. And that employer says, okay, if we stop making all of our payroll deposits today, then over the next quarter, that will leave us with an additional $25,000 that we have not deposited. That employer would still have a $25,000 gap between the cash they can retain by not making their deposits and the total amount of their credit. So at that point, that employer has the option to file a claim via a Form 7200 and ask for that remaining $25,000 of cash that the employer anticipates needing to pay their credits. After those two options are expended, and I guess one more notable thing is the IRS has been clear, multiple Forms 7200 can be filed for the same quarter. So if we do that math, say the first or second week of a quarter, and file our Form 7200 accordingly, and then by 4 or 5 weeks into the quarter, we realize that we're going to need to provide more paid leave than we expected, we can file an additional 7200 to supplement and get us up to whatever that revised amount of credit we expect to qualify for is. And then the third option is really the backstop for any taxpayers that have used, whichever mix and match of the first two options. If that still hasn't, at the end of the quarter, you still haven't received the full amount of your credit, you can file a refund claim on your next quarterly payroll tax return, so your next quarterly Form 941. At the bottom of the slide is just, and there's an additional reminder, this is a fully refundable credit. So the three options that we just talked through should ultimately be used to ensure that an employer that provides the required leave is reimbursed for the full amount of the credit. So the full amount of wages plus the share of health plan expenses plus the employer's 1.45% share of Medicare until we received every dollar of potential credit. And that's, I think as the examples in the first three bullets in the slide kind of highlight, it's not just employment taxes that you would otherwise be eligible to receive that create any sort of a cap on the amount of the credit that you can claim. You can get your full amount of cash back through those three options, and you should get it back with the backstop being the option to file your 941 and claim any remaining refund that is owed to you. Okay, slide 13 is a continuation of the next steps and action items that we wanted to highlight for employers anticipating FFCRA credits. This is a dense slide, and honestly, I've even abbreviated a good portion of it. I won't cover everything on this verbatim, but I think suffice to say, listen to what I have to say today. Take a look at the details in the slide. If you have specific questions, feel free to reach out to me. Feel free to reach out to your Miller Johnson attorney or your ordinary tax advisor, and get the advice that you need to help enact these, because it is a lot. So moving into the bullets on the slide, the first bucket of information that an employer needs to create and maintain to substantiate FFCRA credits is certain information must be collected from employees that are receiving the paid leave. And this, I just simply, rather than fill the slide with what's required, I noted that Miller Johnson has forms available. One reason that I did not want to try and lay out everything that's required is the information that should be collected from employees can change depending on the reason that employee is on paid leave. So for example, different information is required for an employee who is not working because they've shown symptoms or they're pending a diagnosis of potential COVID-19 issue, compared to an employee who, say, is missing work because schools are closed and they don't have daycare options available for their children, so they're at home watching their children. So like I said, depending on what the situation is, Miller Johnson has standard forms available that employers can use to give to employees who are taking paid time off and retain in an employer's files to substantiate their credits. The next bullet gets into some more specific details coming out of some guidance that the IRS provided on what taxpayers claiming the credits should maintain to substantiate their credits. Generally, there's three buckets to watch for. The first is documentation to show how the employer determined the amount of qualified sick and family leave wages paid to employees that are eligible for the credit, including records of work, telework, qualified sick leave, and qualified family leave. The second bullet is documentation to show how the employer determined the amount of qualified health plan expenses that the employer allocated to wages for purposes of determining credits. That would include copies of any completed Form 7200 that the employer submitted to the IRS, and then finally copies of the completed Forms 941 that the employer submitted to the IRS, or for employers that use third-party payers to meet their employment tax obligations, records of information provided by your third-party payer regarding your entitlement to the credits claimed on Form 941. That's obviously a lot of documentation. The service has also provided that all of that documentation should be maintained for the next 4 years, basically, in order to be prepared in case credits claimed under FFCRA are ever subject to an audit. Okay, on slide 15, we're moving into the third and final topic today. I saved this for the end because I think that it's probably the most dense of these topics, the most dense of these credits to work through. That's the employee retention credit under the CARES Act. On slide 15, we provided the general rule again to tee up the discussion. And honestly, for this provision, the general rule kind of bleeds into the next few pages. You'll see what I mean as we work through. The general rule is that the employee retention credit is a fully refundable tax credit equal to 50% of qualified wages, and we'll get into what that definition of qualified wages is. But it includes an allocable share of qualified health plan expenses similar to FFCRA that the employers pay their employees. The credit generally applies to qualified wages paid after March 12, 2020 and before January 1st, 2021. And the maximum amount of qualified expenses taken into account with respect to each employee for all calendar quarters is $10,000, so that the maximum lifetime credit that can be earned with respect to any specific employee is a $5,000 cash tax credit. And that's something I wanted to highlight because if you look at the language within the Act, there's some references to this credit being determined on a quarterly basis. So we've had questions around, does that mean we can pay $10,000, up to $10,000 a quarter and receive $5,000 per employee per quarter? And that's not the case. It's $5,000 per employee lifetime for this credit. Slide 16 continues to work through kind of the list of, or it continues to work through the general rule, and this is where we get into which employers qualify for the credits. So generally, all employers can qualify regardless of size, and regardless of whether you're for-profit or nonprofit, except one, the first exception is employers receiving a PPP loan. The second exception is federal, state, and local government employers. Touching back on employers receiving a PPP loan, I think it's important to highlight here with respect to the retention credit, there's a difference for PPP loan recipients and whether they qualify when you compare it to the discussion we had around tax deferral. That's employment tax deferral that's provided under the CARES Act. And that's because for purposes of the retention credit, receiving a PPP loan in and of itself is enough to disqualify an employer from claiming these credits. So there's no question or no timeline on what if we receive a loan and we don't have our forgiveness decision until a future date, can we take advantage of the credits in the interim? And the answer to that is no. If you receive a PPP loan, you're disqualified from the retention credit discussion. In addition to, or as an additional layer of qualification, so the top of this slide talks about some more high-level qualification issues or questions. As a second layer, in order to qualify, an employer must experience either a full or partial shutdown of its business due to a virus-related government order, or a 50% decline in gross revenue, or excuse me, gross receipts for a calendar quarter in 2020 compared with the same quarter in 2019. And the purpose of the rule there is that, you know, what the retention credits are, the taxpayers that these are really meant to benefit are people that clearly have a slowdown in their business due to the virus. That can be either, and I'll go back to the slide, that can be either because a business is directly either fully or partially shut down as a direct result of a government order, or we're a business, for whatever reason, whether it's deemed essential or however, for a business that is able to remain open despite an applicable government order, if that business shows a 50% decline in gross receipts. So, under either of those tests, we can see a business that's clearly been impacted. The goal of this credit was to incentivize employers to keep employees on payroll while they're able to, despite the slowdown in the business. So let me make sure I got the right slides. Okay. So slide 17, when we think about those two tests, that kind of creates a gating issue for employers that are going to claim the credit, because there's different guidance that applies depending on which of those two tests an employer uses to qualify for their credit. So this slide focuses on additional guidance that's become available and it's been issued by the IRS specific to employers that qualify for the credit because they've been fully or partially shut down by a government order. As a timing point, the first bullet, if an employer qualifies as a result of being subject to a government order, that employer continues to qualify. So wages that employer pays would continue to qualify for the credit so long as that order or another similar order restricting the business remains in place. So that's if this is the test under which an employer qualifies, that's your timeline to watch wages and watch what might qualify for the credit. The next few bullets discuss some of the common questions that were out there following enactment of the act and additional guidance that the IRS has provided. One of the big questions initially was, well, what if we're impacted by a government order, but we're not completely out of business? Does that qualify as a shutdown or a partial shutdown? What do we mean by partial shutdown? And the IRS has since issued guidance broadly interpreting the definition of a partial shutdown for purposes of identifying qualifying employers. And what the IRS said is that a business that can continue to operate, but not at its normal capacity due to a governmental order that imposes restrictions upon business operations by limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to a COVID-19 issue, that business would be subject to partial shutdown. So again, the key being you're not completely shut down, but when you look at the impact that the governmental order has had on your business, you are not able to operate at normal capacity. And so you're subject to a partial shutdown and you would qualify for the credit. The example that the IRS gave of a partial shutdown is a restaurant that normally offers sit-down service, but can only serve customers via carry-out or delivery pursuant to an executive order that was issued in response to COVID-19. Moving to slide 18. This is additional guidance that's specific to employers who qualify for the credit because they've experienced that 50% decline in gross receipts that we mentioned a couple slides back. Here, based on the way that the act was written, the biggest question was if we meet that 50% reduction test for a given quarter, how long do we continue to qualify? Do we qualify for only that quarter? Do we qualify until we're back over 50%? This is another area where the act and some additional guidance that's been provided by the IRS provides a fairly favorable result. And that is if an employer experiences a 50% decline in gross receipts for a calendar quarter in 2020 compared with the same calendar quarter in 2019, that employer begins to qualify for the retention credit on the first day of the quarter in which the 50% decline occurs. And that employer continues to qualify until the end of the calendar quarter in which gross receipts of that employer exceed 80% of gross receipts for the same calendar quarter in 2019. So what that would effectively mean, for example, is if an employer during second quarter, so during the current quarter of 2020, experiences that 50% decline and we're not back above 80% until the fourth quarter of 2020, that employer would qualify for the retention credit for all of quarters 2, 3, and 4 of 2020. Slide 19, again, still working through some of the basic rules for purposes of determining who qualifies for credits and what amounts qualify. This slide starts to get into more specifics around how an employer can determine. So I guess to back up, if we have an employer that meets the general requirements, right, they haven't received a PPP loan, they're not a government employer, and they've been subject to a partial or complete shutdown as a result of a government order, or they've experienced that 50% decline in gross receipts. The next question for those employers is, now we know we qualify, we know what our timeline for paying qualifying wages is, so how do we define qualified wages for determining the amount of our credit? And it's another dense area, and I say that because the calculation of qualified wages depends on another question, which is, what is the average number of an employer's full-time equivalent employees, or FTEs, during 2019? For that purpose, an FTE is generally any employee that averages 30 hours or more per week. And what the rule says is that if an employer averaged more than 100 FTEs during 2019, qualified wages include only wages paid to employees while they are not working. The other piece of that rule is that for employers that had 100 or fewer FTEs during 2019, qualified wages include all wages paid to all employees during the period that the employer qualifies, regardless of whether they are working. So those are two areas where we've received a lot of questions. One that I've seen frequently is under the first bracket, or the first leg of that rule, for employers that average more than 100 FTEs and will only be able to include qualified wages paid to employees while they are not working. The employee does not have to be out of work for the entire quarter in order for wages to qualify, but it will only be, wages will only count for the periods during the quarter when the employee is paid but not working. So again, you don't have to have someone at home for the full quarter, but you're still only going to be able to pay them for periods that they are at home during the quarter and they're being paid not to work. And one final note at the bottom of this slide, for all employers, wages used to claim an emergency sick leave or emergency FMLA payroll tax credit under FFCRA do not qualify for employee retention credits. So basically what that's saying is you can't double dip. If you're already going to be fully reimbursed for paying sick leave through an FFCRA credit, then you can't also use wages paid for that sick leave as a basis for a retention credit. Moving on to slide 20. So this is where we get into, more concrete action items and next steps for employers that are anticipating benefits from retention credits. For anyone that might notice, the bullets on this slide are the same bullets that we talked through for FFCRA credits, with a similar goal of allowing employers who expect to qualify for retention credits in a given quarter to stop making payroll deposits or file Form 7200 claiming advanced credits during the quarter, so that an employer can receive as much of the cash they expect to pay people who are not working upfront to fund those wages during the quarter. You might also notice that the additional bullet that we discussed for FFCRA it's not available yet for the retention credit, is what documentation is the IRS going to ask taxpayers to maintain to substantiate these credits for an audit in future years. I think safe guidance right now, or a good rule of thumb for employers that are planning to take retention credits, would be to look at the guidance available for FFCRA credits on slide 13, or excuse me, I think 14 under the deck we're using right now, but look at the guidance, look at what's listed for FFCRA credits. Other than, you're not going to need to collect information from employees, but the other information on, how is paid time off calculated, how were allocable health plan expenses allocated, those sorts of details. I think the best a taxpayer can do right now is plan to gather that documentation. And then obviously if we receive further guidance from the IRS, we can react at that time. Okay, moving on. Oh, and excuse me, that's it. So those are the points that I wanted to cover today. I hope this was helpful to anyone that's on and had questions. This has definitely been an evolving area. I am fully expecting that we'll receive further guidance from the service, probably on all 3 points that we covered on today. So Miller Johnson will be watching for that, and we'll be providing updates on our website. And in the meantime, like I've mentioned a few times, definitely feel free. I would encourage you to reach out to your Miller Johnson attorney or reach out to me with any specific questions. I know even with the additional details today, there's bound to be additional questions given specific circumstances. So please don't be afraid to reach out, and we will definitely be happy to help. And with that, I will end the presentation. So thanks again, everyone, for joining, and look forward to talking to everyone again when we have more updates. Thank you.